Welcome back to another episode of Investing Explained. Here's today's question. Wow, that's a really insightful question. I really like that. So, first about Buffett. Yes, it is a common misperception that he is the best stock picker in the world. He is fantastic, but he's likely not the best. He is, however, one of the very best business people in the world. And I think this is best exemplified if you look closer at the Berkshire businesses. The value of Buffett's stock portfolio is smaller than the value of his operating businesses. And what Buffett has been so good at is to build, grow, and manage a collection of operating businesses. So just one famous example is whenever he bought up insurance companies and used the so-called float, meaning the premium we as consumers pay for our insurance. And Buffett used and still uses that float to invest in the stock market. Because you can accumulate a lot of wealth if you have billions of essentially free money to invest in compared to a slightly better stock picker that only invests what he makes from his day job. And then you ask about the TIP business compared to picking individual stocks. Now, we all heard these stories about investing in Amazon, Google, or whatever company many years ago, and the value of that investment has just been growing, say, 100-fold. However, most of that return that we make for the investor who has not been smart enough or lucky enough to invest in these amazing growth stories is really from investing in the right asset class. And by that I mean the price to value ratio and not so much on the individual investment. For instance, which specific stock to buy. So let me give you an example. If you make $50,000 per year and you're able to set aside $2,000 per year, the size of your portfolio will likely not depend on which stocks you invest in, but rather how much money you make and in turn how much you're able to set aside. And then it's depending on which asset class you decide to invest in, stocks, bonds, real estate, commodities, or whatever asset class that is priced most attractively. For instance, if the stock market is priced at a very low expected return, which it is right now, you'll just be fighting an uphill battle with a diversified portfolio. And you might be able to beat the market's, say, 3% expected return and make 4%, which in itself would be really impressive. Beating the market is really hard. But perhaps you should take a look around and see where you can put in your time and energy to find an asset class where you can expect to make a significantly higher return. Now, I know I make it sound a lot easier than it really is, but please allow me to provide an example. Through my holding company, I'm investing in a real estate deal where I make an 11% return annually. And the risk profile is different than investing in the stock market. And if I've done my homework right, the risk will actually be lower, but it definitely requires a little more work than just investing in the stock market index. Also, for many private deals, you cannot invest an indefinite amount into the investment, which you sort of can in the stock market. And you also have to learn about a new asset class. So more than thinking like an investor, I had to think like a businessman in the process to set up what hopefully turns out to be a profitable deal. But as you point out, it's really two sides of the same coin. And this is the tricky part. Being both a businessman and an investor will likely not pay off in the short run. For instance, whenever I was a professor at the local college, I could choose to make short-term money by teaching an extra class per week. Or I could create assets like recording more podcast episodes or building a new course. But that won't pay me anything, or at least not in the short run. So whenever you educate yourself as an investor and as a businessman, you end up spending a ton of time on research and you make many mistakes. And if you can set aside, say, $2,000 per year, whether you return 3 or 4% the first year won't really have an impact. But being a good businessman will allow you to set more money aside each month, and you will be able to generate a significantly higher return because you will have the skill set to move around in the respective asset classes and even navigate better in the same asset class like equities, where you'll be able to pick much better stocks.
I really like this question, and I don't think it's anything that I've really talked about too much on this show, but I've talked to friends, family, acquaintances about this idea before. And the thing that I tell these people when we have conversations is I almost feel like a lot of people in business, particularly people that were entrepreneurs that stood up a company that was successful. And I would call something successful if the company's capitalized at $10 million or somewhere in that ballpark. I would call that success. But what you find a lot of the times is these private companies that kind of hover around between the $10 to $50 million mark, these founders are really good at the operational business. Whatever that product or service is, they've mastered it. They've done really well for themselves, but they kind of hit like a ceiling and they can't get past that growth point. I would argue, and this is very arguable, some people might have a different opinion. I would argue that those founders, if they continue to be in the management role and control the equity of that business, have difficulty expanding and growing beyond that mark. Some of them might not want to, but I think a lot of them struggle to go beyond that mark because that's where their business has to transition from being an expert at whatever that product or service is to being great capital allocators of their retained earnings. So that business is producing earnings every year. Now they've got to figure out a way to go beyond that product or service that they've mastered and that they understand really well. And they have to start allocating that non-operationally. Now the returns, when that person makes that transition to a non-operational form of allocating their retained earnings, is often very difficult because the returns that they're getting on that capital is lower than the returns that they had seen by investing locally in their business or in that product or service. And the main reason why is because when you're creating the assets inside your business, it's definitely more risky, but there's also a whole lot more upside to that because you're setting everything up. There's no middleman. There's no person that's cutting away at that profit margin. When you're allocating resources in stocks, bonds, whatever security you're talking about, you often get into a point where you're just buying the assets that somebody else produced. You're also competing against all the other people out there that are trying to own that equity that's in the public sector. And sometimes even in the private sector, it can get very competitive for the value of certain businesses, depending on how strategically aligned it is with your business. So I know that's a really long answer to your question, but I think it's important for people to understand that a lot of the stuff that we talk about on our show, which is investing in companies that are public securities, are lower return type investments than if a person would be able to invest operationally in themselves and create a product or service that serves the marketplace in a competitive way. So I think that transition is very tricky, and I think that that's one of the reasons why so many people can't do it is because they have to step out of what it is that they know to understand how finance is done. You know, a lot of these businesses that go this route, they have somebody else to do all their accounting. They're not looking at the income statement and the balance sheet kind of with that investor mindset or that investor eye that a Warren Buffett looks at both parts of the business, the operational side and the non-operational side, equally and from a similar light.
That's it. Preston and I will continue explaining investing, so go ahead and hit that subscribe button.